You've been sort of positive about the underlying fundamentals recently, Mohamed, I think, and you've been a voice of calm in what has been pretty turbulent, obviously, for the past 2 months. Where are you today?
I'm still constructive on the U.S. economy. There are concerns out there, particularly that this market volatility will contaminate sentiment, both for households and companies. But the underlying economy remains strong, and the labor market remains strong, and the business sector remains strong. I think, Joe, we are simply paying back years of ample and predictable liquidity, having decoupled asset values from fundamentals and having changed behaviors. And now we're going back to something more normal, which is good for the long term, but we've got to navigate this journey.
Wow, so it's the old normal is what you got to coin that term, I think, Mohamed. So we're going away from your new normal back to the old normal, basically? Or
yeah,
the Fed?
I mean, the big aberration in markets isn't this year. It was last year, where everything went right for investors. They got great returns, they got virtually no volatility, and every correlation broke in their favor. That was the aberration, and now we are transitioning back to something more normal, which, by the way, is better over the long term. We just have to minimize two risks. One is that bad technicals contaminate the economy in the U.S., and two is that people lose confidence in the functioning of market. I think one thing that we have to worry about is that the retail investors is looking at these wild markets and saying, I don't get this. Maybe I shouldn't be in these markets to begin with, and that's a real danger.
Usually you can get to a studio or a set. What are we talking about? St. Bart's here? Why the phone? Why the phoner, Mohamed? Give us let us see into the lifestyles of the rich and famous. Where are you? Where are you? Or you don't want to? You're in a secure, undisclosed location.
No, I'm at home in my pajamas at 5:30 in the morning.
Okay.
That's fair.
You got one of those little things in back, a little. That's what I sort of see.
Mohamed, I want to hear more about the pajamas and the home.
Yeah, no. But ask. So does this finally work itself out, Mohamed, where we don't worry about another 20% down in the stock market?
Or I wanted to ask it another way. Just a very similar question. We've had these periods in the stock market where they've kind of ripped down over the last couple of years, one earlier this year in February, going back 2015, 16, and then it comes right back. So just to piggyback on Joe's question, I think what I'm hearing you say is that's not going to happen again.
Yeah, it's not going to happen because unlike February, the global economy is more uncertain. Remember, February, we were still in love with the synchronized pickup in global growth. Okay, now we understand that Europe, China, and Japan are slowing and are more uncertain. Secondly, we have central banks that are stepping away. I'm amazed how much flack the Fed has got relative to the ECB. The ECB is tightening into a much slower economy, bigger debt loads, and a more uncertain political environment. So, understand that this is a very different central bank environment, and that's not going to go away. So, no, this is not going to be like February.
Should the ECB get more criticism or the Fed get less criticism?
I think that first of all, I think the Fed should get less criticism as to what it's doing, but it should be held accountable for how it communicates what it's doing. I was on set a few weeks ago, and I said they made two big mistakes. First, you cannot emphasize that balance sheet management is an automatic pilot. That puts way too much of a burden on the interest rate policy. And secondly, you've got to convince people that you're much more sensitive to spillbacks from the rest of the world and from technical markets. If you do that, I think the Fed can navigate this period. So, the ECB is going to have a much tougher time.
So, Mohamed, in an old normal environment, what group of stocks, what asset classes, what works?
So I think what works here is what works in technically vulnerable markets, which is pick up the overshoot. When you get these sort of violent technical adjustments, the good gets thrown out with the bad. So there are lots of companies out there with sound balance sheets, very high cash generation, good business models. They're going to navigate through this fine, but they're going to trade for a while at ridiculous levels. And that's what people should focus on. It is really a security selection environment across the board, not only in stocks, by the way, in bonds as well.
Mohamed, biggest risk for next year that's not really known in markets, not priced in?
I think the biggest risk is a huge policy mistake, that you get paralysis because of politics, and you've seen this in Europe already. You get China misstepping, and then the central banks turn out to be a massive amplifier of volatility. They've got to keep their eyes open on this, because the rest of the world is in much worse shape than the U.S. is, and that's the reality we have to understand.
Mohamed, so 2019, do you expect elevated volatility to continue? Not necessarily like it's been this week, but...
I do, and I keep on looking at a VIX chart and saying the real aberration is not what we're seeing now. The real aberration is we're coming from a period of repressed volatility. It wasn't low volatility, it was repressed volatility, and now vol is finding its own level. And we're going to figure out, and we are figuring out, that the system overpromised liquidity to end users during periods of ample central bank support, and now people are realizing they don't have as much liquidity as they thought they did. And when that happens, you end up selling whatever you can sell, not what you should sell.